What if I told you that the money sitting in your bank account isn't the bank's biggest asset? Your trust is. Most people believe banks exist to protect their money. That's what we've all been taught. But the moment I discovered how banks actually make money and what it really means to own one, I realized I'd believed the same myth as millions of other people. Here's the scary part. The most dangerous thing about owning a bank isn't losing money. It's losing people's trust, because the day trust disappears, even $1 billion bank can begin to fall. What's the truth that almost nobody tells you about owning a bank? For most people, a bank is a simple place. You put your money there, the bank keeps it safe, and whenever you need it, you take it back. That is the image most of us grow up with. A building with security guards, employees behind counters, and a vault somewhere in the background protecting everyone's savings. But that picture is incomplete, because a bank is not simply a place where money sits. A bank is a machine that moves money every single day. Millions of people deposit their earnings, families look for loans, businesses search for funding, and companies look for opportunities to grow. And sitting right in the middle of all of these financial decisions is the bank. That is where its real power comes from. Think about it this way. Imagine one person has spent years saving money, but doesn't know how to use it to create more value. At the same time, another person has a great business idea, but doesn't have enough money to turn that idea into reality. One person has resources but needs an opportunity. The other has an opportunity but needs resources. The bank connects these two worlds. It takes money from people who want to save and helps provide money to people who need capital to build, create, and grow. This simple process changed the way modern economies work. Without banks, buying a home would become much harder. Starting a business would require years of personal savings. Many companies that create jobs, products, and services might never exist. But here is where most people misunderstand banks. They think a bank becomes powerful because it stores billions of dollars inside its vaults. That is not what makes a bank valuable. The real business happens after the money enters the system. Banks earn money by helping people and businesses access capital, providing financial services, managing risk, and creating a system where money can continue moving. And this is the part most people never think about. A bank is not just managing money. It is managing decisions, opportunities, and the financial confidence of millions of people. That is why some banks become among the most powerful companies in the world. But banking has something that makes it completely different from almost every other business. A restaurant can survive if customers love the food. A technology company can survive if people believe in its products. A clothing brand can survive if people like its designs. But a bank depends on something far more fragile: confidence. Because when people believe a bank is reliable, they continue depositing money, using its services, and building financial relationships with it. But when that confidence starts to disappear, everything can change. A bank can have impressive buildings, advanced technology, and billions in assets. But if customers begin questioning whether their money is truly safe, the entire foundation of that institution can be tested. And that is the hidden reality behind owning a bank. You are not simply owning a company. You are taking responsibility for something that millions of people rely on every single day: their savings, their businesses, their homes, their financial future. This is why owning a bank is not just about wealth or power. It is about managing one of the most valuable things people can give another institution: their confidence. And now we reach the question that reveals the real business behind banking. If banks are trusted with so much money every single day, how do they actually transform that trust into billions of dollars in profit? Because the answer is very different from what most people imagine. And that is where the real story of banking begins. Most people think they understand how banks make money. They believe it is simple. People deposit their money, the bank keeps it safe, and somehow the bank becomes rich. But that explanation misses the most important part of the story. A bank does not become powerful because money is sitting inside its walls. It becomes powerful because it controls the movement of money. That is where the real business begins. Imagine millions of people depositing their savings into a bank. One person deposits $1,000. Another deposits $5,000. Someone else deposits $20,000. Individually, these amounts may not seem extraordinary. But when millions of people do the same thing, the bank becomes connected to a massive financial network, and this is where banks provide one of their most important services. They connect people who have money with people and businesses that need money. Think about a family that wants to buy a home but does not have hundreds of thousands of dollars saved. Think about an entrepreneur who has a great idea but needs funding to turn that idea into a real company. Think about a business that wants to expand, hire employees, and build something bigger. The bank can provide the capital needed to make those things possible. But here is the part many people misunderstand. The bank is not simply giving money away. It is providing access to money. And that access has a cost. Borrowers pay interest over time. And that interest becomes one of the major ways banks generate revenue. For example, when a bank provides a mortgage, the borrower eventually pays back the original amount plus additional money for using that capital. The difference between what the bank earns and what it pays to access money is one of the ways it creates profit. Now imagine this happening millions of times, millions of loans, thousands of businesses receiving funding, countless financial transactions happening every single day. A single customer may not create a huge amount of revenue for a bank, but millions of customers together create one of the most powerful financial systems in the world. And lending is only one part of the story. Modern banks have built entire ecosystems around people's financial lives. They process payments, help businesses manage money, provide credit, support investments, move money across countries, and create financial tools that people use every day. Each individual service may seem small, but when combined across millions of customers, they create enormous value. This is why the biggest banks in the world are not just buildings with employees and vaults. They are massive financial networks powered by technology, data, expertise, and millions of relationships. But there is something even more valuable than the money flowing through these institutions. It is the relationship they build with their customers. Think about your own life. Your bank may receive your salary. It may help you buy your first home. It may provide your credit card. It may help you save and plan for the future. Over time, a bank becomes connected to some of the most important financial decisions people make. And that connection is extremely valuable because the real business of banking is not just moving money. It is becoming the place where money decisions happen. And this is exactly why owning a bank is different from owning almost any other business. You are not just selling a product. You are managing a system that millions of people depend on every single day. But every powerful system has risks. When banks provide loans, they are making decisions about the future. They are trusting that individuals and businesses will be able to repay what they borrow. And when those decisions go wrong, the consequences can spread far beyond the bank itself. A bank can generate billions in profit, but one major mistake can damage the very foundation that allows it to exist: trust. So if banks have the ability to generate enormous profits, what hidden risks can bring even the largest financial institutions to their knees? That is where the story becomes even more interesting. When most people think about a bank making money, they usually think about one thing: loans. A person borrows money. The bank charges interest. The bank earns profit. And while that is an important part of banking, it is only the beginning. The biggest banks in the world are not powerful because they give loans. They are powerful because they have become connected to almost every financial decision people make. Think about your own life. Your salary enters through a bank. Your bills are paid through a bank. Your online purchases move through banking systems. Your savings are stored there. Your future plans, investments, and major financial decisions often involve a bank somewhere in the process. And that creates something extremely valuable: a constant relationship with people's money. This is what separates banks from many other businesses. A company might sell you a product once. A restaurant might serve you a meal. A technology company might sell you a device. But a bank can remain connected to your financial life for years, sometimes even decades, and every stage of that relationship creates new opportunities. A customer who starts with a simple savings account may later need a credit card. They may apply for a home loan. They may invest for retirement. They may start a business and need financial support. The bank grows alongside the customer's financial journey. And when millions of customers have the same relationship, that becomes a powerful financial network. But this influence is not created only through individuals. Banks also play a major role in the business world. A company that wants to expand may need funding. A global corporation may need help moving money across countries. A growing business may need systems to manage payments, employees, and investments. Banks become the connection point that allows businesses to operate and grow. And the larger the business, the more valuable that relationship becomes. But there is another side of banking that makes it different from almost any other industry. Banks are not just handling transactions. They are making decisions that can affect people's futures. Every loan approved, every investment made, every financial decision taken carries a level of responsibility because banks are not simply managing their own money. They are managing the confidence of millions of people who trust them with their financial lives. And that confidence is what gives banks their real power, not the buildings, not the technology, not even the money they manage. The true strength of a bank comes from the trust and relationships it has built over time. Because once a bank becomes a trusted part of people's lives, it becomes more than a business. It becomes part of the financial system itself. And this is why owning a bank is so different from owning almost any other company. You are not just owning an organization that earns profits. You are owning a position inside a system that moves money, supports businesses, and influences major financial decisions every single day. But with that power comes enormous responsibility. Because when a bank makes a mistake, the consequences are not limited to the bank itself. They can affect customers, businesses, investors, and even the wider economy. So the question becomes, if owning a bank gives someone this much influence and responsibility, who is actually allowed to own one? And what does it take to control an institution trusted by millions of people? That is where the story becomes even more fascinating. Most people think owning a successful business is about one thing: making money, more customers, more sales, more growth. But owning a bank is different because a bank does not simply sell a product. It influences where money flows, and where money flows often determines what gets built, which businesses grow, and which opportunities become possible. Think about a small business owner with a great idea. They have the skills, they have the ambition, they have a plan, but without enough money, that idea may never become a real business. A bank can provide the funding that turns that idea into reality. It can help that business open its doors, hire employees, purchase equipment, and create something valuable for the community. Now imagine that happening thousands or even millions of times. A bank helps businesses expand. It helps families purchase homes. It helps people invest in their future. The decisions made inside a bank can influence the lives of millions of people. And this is what makes banks different from almost any other business. A company that sells products becomes successful by convincing people to buy something. But a bank becomes powerful because it helps determine where financial resources are directed. It sits between ideas and opportunities, between businesses and growth, between plans and reality. That position creates enormous influence. But with that influence comes a responsibility that few other industries carry. Banks operate under some of the strictest rules in the business world because their decisions can affect far more than just their own company. A mistake made by an ordinary business may affect its customers and employees. A mistake made by a major bank can affect millions of people, businesses, and investors. This is why governments, companies, and financial markets pay close attention to what banks do. A strong banking system can help an economy expand. But when banks face serious problems, the effects can spread far beyond the financial industry. Businesses may struggle to access funding. People may become uncertain about spending. Investors may lose confidence. And a problem inside one institution can create fear across an entire system. But there is another reason owning a bank is so valuable: trust. Trust is one of the hardest things any business can build. A new company may spend years trying to prove that customers can rely on it. But banks already sit at the center of people's financial lives. People trust banks with their salaries, their savings, their homes, their biggest financial decisions. That trust is not just valuable, it is the foundation that allows the entire banking system to operate. But here is the dangerous part. The same thing that makes banks powerful can also become their greatest weakness. A bank can survive competition. It can adapt to new technology. It can overcome economic challenges, but it becomes vulnerable when people stop believing in it. Because a bank does not run only on money. It runs on confidence. And confidence can disappear faster than most people realize. Sometimes it only takes a single event, a financial mistake, a serious problem, or even a loss of public trust. And suddenly, a powerful institution can face a challenge it never expected. Because the hardest part of owning a bank is not simply making billions in profit. It is protecting the trust that makes those billions possible. And that leads us to the most dangerous side of banking. What happens when that trust breaks? And why can even powerful banks collapse? From the outside, owning a bank can look like the ultimate business opportunity. A powerful institution, millions of customers, huge amounts of money moving through the system every single day. It looks like a business built for success. But behind that success is a reality most people never see. A bank is one of the few businesses where its greatest strength can also become its greatest weakness. Because a bank does not only manage money, it manages belief. When someone deposits money into a bank, they are not thinking about complex financial systems, investment strategies, or economic models. They are thinking about one simple question: will my money still be there when I need it? That question is the foundation of banking. As long as people believe the answer is yes, the system continues to function. Customers deposit money. Businesses use financial services. Loans continue. The entire system keeps moving. But what happens when that belief begins to disappear? Imagine a rumor starts spreading that a bank might be facing problems. At first, only a few customers become concerned. Then more people start asking questions. Then thousands of customers begin thinking, should I take my money out before something happens? And suddenly, the biggest challenge is no longer only financial. It becomes psychological, because a bank does not need to completely run out of money to face a crisis. Sometimes the crisis begins when too many people stop believing the bank will be there for them. And that is what makes banking so different from almost every other business. A restaurant can lose customers slowly because of bad service. A clothing company can struggle because trends change. A technology company can fail because competitors create better products. But a bank can face a completely different type of pressure. Thousands or even millions of people can make decisions at the same time based on fear, and fear moves quickly. This is why owning a bank is not just about creating profits. It is about managing risk. Every loan approved, every investment made, every decision about where money goes carries consequences. A bank may look successful during good economic times. People are borrowing, businesses are expanding, markets are growing. Everything appears positive, but conditions can change. Businesses may struggle. Borrowers may fail to repay loans. Investments may lose value, and problems that seem small at first can create a chain reaction. Losses increase, investors become concerned, customers start asking questions, confidence begins to weaken, and suddenly, a bank that once appeared powerful can find itself under enormous pressure. This is why successful banks spend so much time preparing for problems that may never happen. They create safety systems. They maintain financial reserves. They analyze risks. They prepare for difficult situations. Because in banking, success is not only measured by how much money a bank makes during good times, it is measured by how well it survives when conditions become difficult. And history has shown that even respected financial institutions are not immune. Some banks that once seemed unstoppable collapsed because they underestimated risks, made poor decisions, or failed to protect the confidence people placed in them. And this reveals the most important truth about owning a bank. The thing that creates a bank's greatest power can also become the thing that destroys it. Trust creates strength, but losing that trust can create weakness. Because when millions of people depend on you with their savings, businesses, and financial futures, one mistake is not just a business problem. It can become a much bigger crisis. And to truly understand the risks of owning a bank, we need to look at the moments when some of the world's most powerful financial institutions learned this lesson the hardest way possible. For decades, some of the biggest banks in the world looked almost impossible to defeat. They had billions of dollars in assets, thousands of employees, millions of customers, powerful names built over generations. To the public, these institutions looked untouchable, but history has revealed a lesson that every bank owner must understand. No financial institution is too powerful to face a crisis, because a bank is not built only on money. It is built on confidence. And when that confidence begins to disappear, even the largest banks can face problems they never expected. One of the clearest examples came during the global financial crisis of 2008. Before the crisis, everything appeared stable. Banks were lending. People were buying homes. Investors believed the financial system was stronger than ever. Confidence was everywhere, but beneath the surface, serious risks were building. Many financial institutions had taken on loans and investments that became extremely difficult to manage when the housing market started to collapse. As more borrowers struggled to repay their loans, the problem spread. What began as a problem in one area of the economy started affecting the entire financial system. Suddenly, people who once believed everything was secure started asking questions: were banks safe? Could these institutions survive? Could people still trust the system? And that was the real danger. The problem was not only about financial losses, it was about confidence disappearing. Because once people begin doubting a bank, the pressure can increase incredibly quickly. Some banks failed. Others needed emergency support. Governments stepped in because banks are connected to almost every part of modern life. Businesses depend on banks for funding. Families depend on banks for homes and financial services. Companies depend on banks to keep money moving. A problem inside the banking system does not stay inside a bank. It can spread to millions of ordinary people. But the lesson from banking failures is not that banks are bad. The lesson is that banking is one of the most difficult businesses in the world. A bank must constantly balance two competing goals: growing enough to remain successful and being careful enough to survive unexpected problems. That balance is what makes owning a bank so challenging, because a bank owner is not only responsible for increasing profits, they are responsible for protecting an institution that people depend on. And history showed this again in 2023, when Silicon Valley Bank experienced a rapid collapse after losing the confidence of many customers and investors. The bank had become an important financial partner for many technology companies and startups. But when concerns about its financial position increased, customers moved quickly to withdraw their money. The situation developed at incredible speed, and it showed something important about modern banking. Technology has made banking faster and more convenient, but it has also made information and fear spread faster than ever before. A concern that once might have taken weeks to grow can now reach thousands of people within hours. This is why banks protect something that cannot be measured easily: their reputation. For a normal company, reputation affects sales. For a bank, reputation affects survival. People do not choose a bank only because of a building, an app, or a service. They choose a bank because they believe it will protect what matters to them: their savings, their businesses, their financial future. And that belief is what allows a bank to operate. This brings us back to the original question: why is owning a bank so attractive if the risks are so serious? Because when managed correctly, a bank becomes more than a profitable business. It becomes a central part of the economy. It earns revenue from thousands of financial activities. It builds relationships that can last generations. It becomes connected to the financial decisions of millions of people. But that power comes with enormous responsibility. Owning a bank is not simply about having enough money to buy a building and place a sign outside. It requires approval. It requires strict oversight. It requires the ability to protect the trust of millions of customers. And that leads us to the final question. Could an ordinary person actually own a bank? And what does it really take to become the owner of one of the most powerful businesses in the world? Part 7. Can anyone actually own a bank? After everything we have discovered, one question remains. If banks control so much money, influence, and responsibility, why can't anyone simply create one? Why doesn't every wealthy entrepreneur open a bank the same way someone opens a restaurant, a store, or a technology company? Because a bank is not an ordinary business. Opening a bank is not just about having enough money. It is about proving that you can handle the responsibility of managing something millions of people depend on. Imagine someone opening a restaurant. If the food is bad, customers stop coming. If the business fails, the owner loses their investment. But when a bank fails, the consequences can reach far beyond the owner. People's savings can be affected. Businesses can lose access to funding. Families can face uncertainty about their financial plans. That is why banks operate under some of the strictest requirements in the business world. Before a bank can open its doors, regulators need to understand several things. Who is responsible for running it? Do the leaders understand financial risks? Does the bank have enough resources to survive difficult situations? Are there systems in place to protect customers? Because trust cannot simply be bought, it must be earned over time. This is why becoming a bank owner requires much more than wealth. It requires experience, strong leadership, careful decision making, and the ability to manage enormous responsibility. For many people, owning an entire bank may not be realistic. But there is another way people can become connected to the success of banking institutions. Through ownership of shares in publicly traded banks. Investors may not control daily decisions, but they can benefit when a bank grows and creates value over time. This reveals something interesting. You do not always need to control an entire system to benefit from its success. Sometimes owning a small piece of a powerful business can still create opportunities. But for those who actually own and control a bank, the responsibility is on a completely different level. They must make decisions during strong economies and difficult ones. They must balance growth with safety. They must think beyond today's profits and prepare for tomorrow's challenges. Because the biggest mistake a bank owner can make is focusing only on short-term success. A bank can generate billions during good times, but one careless decision can create problems that last for years. That is why great banking leaders are not only focused on making money, they focus on protecting the foundation that allows the bank to exist. The confidence of the people who depend on it, because a bank's most valuable asset cannot be stored inside a vault. It cannot be measured by the size of its headquarters. It cannot be counted simply by looking at numbers. Its greatest asset is the belief that people have in it. The belief of customers, the belief of businesses, the belief of investors. And once that belief is damaged, rebuilding it can become one of the hardest challenges any institution faces. So, what is the real truth about owning a bank? It is not simply a shortcut to wealth. It is a responsibility that combines money, risk, influence, and accountability. Yes, a successful bank can become one of the most profitable businesses in the world. But behind every successful bank is a simple reality. A bank does not own people's confidence. It earns the right to keep it every single day. Because the true power of banking was never only about money. It was about being trusted with something people cannot afford to lose. When most people imagine owning a bank, they picture wealth, influence, and control. They imagine managing billions of dollars and running one of the most important businesses in the world. And while that image is not completely wrong, it misses the most important part. Owning a bank means carrying a responsibility, unlike almost any other industry, because a bank is built on something invisible. Not buildings, not technology, not even money, belief. the belief that customers can safely store their money, the belief that businesses can rely on financial support, the belief that the system will still work tomorrow. That belief is what allows banking to function. And that is why owning a bank is both incredibly powerful and incredibly challenging. Because when people believe in you, you can build something extraordinary. But when that belief disappears, everything can change. So the next time you walk into a bank, open a banking app, or make a financial decision, remember this: a bank is not just a place where money is stored. It is one of the most powerful systems ever created for moving money, creating opportunities, and shaping economies. And the people who own these institutions are not simply controlling financial assets. They are protecting the confidence that keeps the entire system alive. Because the biggest banks in history were never built on money alone. They were built on something far more fragile: millions of people believing they would still be there when they needed them. Now I want to know your opinion. If you had the opportunity, would you rather own a bank, invest in a bank, or build a completely different business? Share your thoughts in the comments. And if you enjoy discovering the hidden stories behind the world's most powerful industries, subscribe for more.